You make a losing trade that you know you shouldn't have. It hurts. What if I told you there was something very important you need to do after one of these trades that can transform your trading career? Hi, I'm Mike Bellafiore, co-founder of S&P Capital, and we're a proprietary trading firm located in New York City, and the author of the trading classic One Good Trade and the Playbook. Founded in 2005, S&P Capital trades stocks and options and futures and crypto, both as discretionary and automated traders. In this video, a promising developing trader at the firm shares a losing breakout trade. Yes, you heard that correctly, a losing breakout trade in step-by-step detail. This prop trader created what we call at our trading firm an anti-playbook trade, an essential trading technique to improve your trading after a gut-wrenching loss. Let's get to work on sharing this important trading lesson so you can turn that trading pain into future trading gains.
So this is an anti-playbook on forced expectations on a breakout trade on Rivian from this week, the 15th. So overall expectations in trading, forcing your expectations is going to skew positive expectancy on any single trade or system.
So what's an anti-playbook trade to you, Dylan?
Basically, there are like certain mistakes now that I'll make that I know are like black and white mistakes, and so for those, putting an anti-playbook together for that way the mistake, not necessarily it doesn't happen again, but I have ways to combat it and a process in place to identify it and make sure it doesn't happen again. I think that's what an anti-playbook.
Yeah, so I was coming up the elevator after grabbing a protein shake, and I ran into you the other day.
Yeah.
And you were despondent. Maybe despondent is a little bit too much, but
yeah.
You weren't too happy. You were peaked.
Yeah.
And we started chatting.
Mm-hmm.
And you talked about how you messed up.
Yeah.
And you talked about the trade you messed up in, and you talked about how you felt.
Yeah.
And you weren't feeling that great.
Mm-hmm.
And we started talking, and I said, I love that you're feeling this way. I want you to feel that way.
Yeah.
I'm really glad, as somebody who runs a firm,
mm-hmm.
that we have people that care. It shows you care,
right,
that you were so piqued
mm-hmm.
about a particular trade. And when we were talking, you were very specific about how you messed up.
Mm-hmm.
You were specific about how you didn't, we'll talk about this a little bit more, but you were
mm-hmm.
specific about what you didn't do, what you should have done.
Mm-hmm.
And you weren't too happy with yourself.
Right, yeah.
And so I said, hey, why don't you and I sit down
mm-hmm.
and do an anti-playbook trade? And
right.
This is you. We talked about this before the open. This is you doing a wonderful job showing your leadership to the firm, because we're going to share this with the firm, and to the trading community who is watching this. This is excellent leadership from you. This anti-playbook trade is a wonderful, effective best practice that people ought to implement into their trading to help them find their edge, to help them eliminate the stuff that's nonsense, the stuff they got to get out of their trading, mm-hmm. the stuff that all of us have in our trading that we got to start doing much less of.
Right.
And it also, when you go through this process, it helps you to internalize what you shouldn't do, the mm-hmm. nonsense you've got to stop doing, because and I saw you in that moment, and I saw your face, and I felt your reaction, and I felt bad for you. This is the stuff you got to stop doing, and
yeah.
you will internalize after you do this that you shouldn't do the things that you did. And it's also going to help you recognize and internalize the trades that you should make. Mm-hmm. Becoming a good trader is about the trades that you should take and understanding them, and the trades you shouldn't take and understanding them. And lots of people, after they made a trade like you, would just have walked out of the building or walked out of their office and maybe went to a bar or found their significant other mm-hmm. or turned on the TV or got on the internet or got on Instagram or Snap or whatever you young people do.
Yeah.
Okay, I hear there's some stuff about TikTok.
Yeah.
Someone's gonna have to explain TikTok to me. I don't dance. It looks like fun. I think I may have missed that whole thing. I'm not going to go on TikTok and start dancing. But, this is, you didn't do that. You sat down and you created an anti-playbook trade of things you shouldn't do. You used your peak, your unhappiness with your trade, and turned it into a solution. I'm not going to do this going forward. And that's how you get better. It's okay to make mistakes.
Yeah.
But you've got to take that frustration and turn it into something constructive. And this is a very effective best practice for turning frustration into something constructive. Understanding what you shouldn't do. Your anti-playbook trade. So we're going to go through this and figure out what you shouldn't do in your trading so that we don't feel that way going forward.
Right. Yeah, appreciate that. So like you mentioned, it's really specific now. We built a bunch of execution strategies within these breakouts to manage our expectations based on a few variables present themselves off the open. The main ones being daily and intraday price action, tape, volume, and market context in the main indices and leaders. So based off how those play out intraday, we're going to manage our expectations differently. And the question we're asking ourselves is how do we stay involved in the most aggressive scenario while managing our risk? And to do that, we use market context and the breakout market breadth data that I'll just briefly mention later to tell us when to be risk on or risk off. And the combination of the execution strategy and the breakout market breadth mitigate our risk in our losing periods when the environment shifts. And when we're wrong intraday, the execution strategy helps us mitigate the risk there.
And you're doing this as a team, right?
Yeah.
So there's somebody on the team that's feeding you market breadth data and responsible for feeding you market breadth data?
Yeah, we built it together, and now each of us are responsible for a different portion of it.
Okay.
Yeah.
And you and another guy are more responsible for strategy, but there's people coming together for this trade in real time to make it better.
Yeah, definitely.
This is an example. We call it team trading. We call it, and with team trading, there are joint accounts. This is a joint account trade. You're doing this with other people. Okay.
Yeah, this is actually on two accounts.
This is a joint account anti-playbook trade.
Yeah, yeah, it is.
We should have all of you in here getting some lashes. All right.
So this is the SPY daily. Just going to mention real briefly, gapping into 200 and the 10 and 20, so short term and a big term moving average. Q's daily, very similar, except it's relatively weak. It's under the 200 and gapping into its shorter term averages.
If you want to learn 3 more real world setups that our traders use, including the simple setup that we teach all of our new traders, and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing now at the top right-hand corner of your screen. That will open up the free registration page in a new window, so don't worry, you won't lose this video. You can also visit tradingworkshop.com to register for this free intensive workshop. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
So the way we look at this is just plain market context. Our major indices are underahead, both short-term and long-term moving averages, gapping into declining moving averages, which is even weaker. So the lack of internal strength and the general breakout numbers have been pretty abysmal.
So that means breakout should work less and breakdown should work more.
Yes. Yeah, that was our first inclination. So that's what happened in the first environment shift. And so then, for market context, this part of our system, we ask ourselves, is this the market context breakouts are going to outperform? And no. Will we usually get our most aggressive scenarios with the indices, this exact market context? Gapping into declining overhead and moving averages? No. So that's a pretty low grade for market context. This is the breadth data. This part gives us an edge for a higher time frame and more environment shifts. So this reflects some of the data we track within 5-day, 1-month, 3-month, and 52-week highs to lows. It's a 4-month rolling period. Even after the environment shift, you can see the green is the 5-day. There are still momentum bursts higher, right? Even in a bear market, when things move lower, things will bounce and things will move higher. It's just a question of how can we actively manage our risk and focus on the things that are actually working within that. So breakouts generally will not work. And so the other part of the breakout data really helps us narrow it down and be very specific to what we're looking at. This is a percentile range of a 52-week range. So if I go to this daily right here, if you split this into 3 parts, the 75th, 50th and 25th percentile. We basically look at all breakouts that are working and like closing higher within those ranges, and we'll formulate it like we basically put it into a visual representation. But the blue bar is when breakouts are working, closing higher under the 25th percent of their 52-week range. And we can see after an environment shift like that, tons of names have come off 50%, 70%, 80%. So that's clearly why we're seeing if breakouts are going to work. They're not working at the 52-week highs or even the middle of the ranges really now. You know, mid-February, they're working at the bottom end of their ranges when they're working at all. So getting very specific to know what we're looking at and what's working. So the second point, what does that mean for us as active breakout traders? The lower end of the 52-week range and shorter time frame breakouts is our new most aggressive scenario, considering what is actually working in this environment. If things shift and things start working again and 1 month, 3 month ranges are holding higher, we're going to broaden our time frame again. But this is generally the data when breakouts underperform. Is there still money to be made in shorter time frame breakouts by adjusting not our execution, but adjusting our time frame and the context that we're trading? Yes. Should we be net long if breakout setups present themselves for us to manage our risk? Yes. When the environment shifted, a little note is moving base risk on breakouts down is a great idea. So we bumped it from, or downgraded it from 1 hour to half an hour for base risk, our initial risk. So just being net long in this case may not be with heavy size, but we want to be in the right frame to say, we're going to do this 100 times with this exact same context, exact same data, exact same setup. Are we going to have a positive expectancy? I think so with this system.
Does the mirror image of this breakdowns show edge?
Yeah, so late January, or January is when we really talked about this and started implementing it. We have not necessarily this on the opposite side, but we have a lot of other data like this showing us the breakdown side. And so we use that data to pinpoint what's going to work or supposed to work late January to capitalize on those breakdowns. But we saw something interesting was both dried up, like the breakouts and breakdowns in February. Interesting enough, like you obviously seen it in the action, but there's just no follow through on either side. So now we're having to get even more specific within both of them, what's actually working. But yeah, definitely was helpful.
Fading.
Fading. Yeah, intraday fading. This is the Rivian breakout setup. It's just a technical breakout. 66.5 is the inflection we're watching. And so we scan a lot of breakout names, probably most names that are setting up to breakout. And we're judging risk reward by what's opening closest to inflection. So the goal of the setup, a setup is just a setup. A setup combined with market context and the breakout data that we just mentioned. The goal of all of that is to manage our risk by only adding more than that initial 0.5 R if we see volume patterns or a changing character with the way it's trading, opposed to before, because that way we can mitigate that risk a lot tighter and expect more out of it on the short term. But if that doesn't happen, we just want to be net long if this were to break out and that day the market gapped up. What if the market is strong? We don't know how the data is going to play out off the open in the morning session. We just want to be net long if things were to break out and it doesn't give us an ad spot. And the goal is to get out majority as intraday targets and hold a little portion if things hold higher. And then this is the important part, the mistake in this, because that's kind of just a system of how you break down, come to a trade. After the market environment shifted in 2021, 2022, we scaled back risk like I mentioned, and we added our breakdown trades like you just mentioned as well. And that was a substantial percent, I think it was about 40% of January P&L. Which is really big. The problem here, mistakes come in after about 2 months. December, January, the main focus was risk mitigation around all setups. Doesn't really matter what's setting up, how it's setting up. We knew what the data was telling us. There was a shift. We knew what the market context was telling us. It's not trading the same way it was before. So the only focus those 2 months was risk mitigation. And for different personalities, this is going to differ a little bit, but for me, my main strength, I'm going to trade my absolute best when I'm focusing on risk mitigation. I know not everyone is like that. Like my trading partner doesn't really want to focus on risk. He wants to focus on the reward because he trades better like that. But for me, expectations crept in on this trade, and I oversized in an environment like this, and that's going to be a massive mistake every single time. It's just because something's set up quote unquote nicely for the first time in 2 months. I should have caught it, but pre-market, I was telling you about some signs. But during our conversation, I talked about bumping our base risk from like, we'll just say 1 hour to like 1.5 hour. That's something I haven't done in the last 2 months. It's something I haven't done since there's like a very specific theme, something's working, I really want to push it. I didn't catch that during pre-market, that I looked to bump that risk. And my trading partner was fine with it, and so we bumped the risk a little bit. And on the open, we do a lot of open trading, very like specific in the scenarios we're trading. I was only thinking about the max amount of shares I can get. Every day for the last 2 months, all I've been thinking about is how can I be net long if this were to happen while managing my risk. That wasn't a part of my mental process that morning. And like I see here, the only goal for, in this period is to manage risk. So any trade decision or execution decision that goes against what the data just shows and everything we've talked about, the whole system is going to turn into negative expectancy when those mistakes come into play. So if I ask myself, if I repeat this action 100 times, same exact, because we can get to the point of specificity to say this same exact market context, same exact data, same exact setup, is the right thing to do? No. Max really need to lose 1 R, and we mitigate our losses very tightly. So 0.5 R mitigated loss is very reasonable in this. And my mistake in expecting this to trade differently and getting that size, momentum size without confirmation, losing 1.8 R, it's nothing like insane. But you repeat that mistake in an environment like this, like it's going to be a drawdown we cannot come out of if we're going to continue to make mistakes like this. But yeah, that's the overall.
What about starting to try and build a new trade? What about trying to build a failed breakout trade?
We talked about fading some of these breakouts when it shifts. For the breakout data, we're not too sure how to time the shift from being long actively to fading, but we're trying to get better on the time frame of like that switch, that adjustment. But I think that could be really useful for when we do see that shift. That trade is obviously going to work a lot better in that environment. That's something we can talk about.
I think the best place to start is the low-hanging fruit for something like that. So what's the most obvious example of a failed breakout that makes sense to you guys, and experimenting with that?
Right.
But don't let it get in the way of your original strategy.
Right. It's a good idea though, definitely for this period. Yeah, I think that's pretty much it. The mistake is oversizing and letting the expectations come into this trade. It shouldn't happen. It's a mistake that I worked hard to get away from, and it just doesn't need to happen when you're being as specific as this.
Hey, go ahead and click our subscribe button so you don't miss any of the videos they're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next, and what you found helpful from this video. From all of us at SMB, train and trade well.